Hello, welcome to Any Answers Answered for April 2022. I'm afraid it is that time of year where we start to look at things ending and other things beginning as part of the change of tax year. And our first question is exactly that sort of situation, though is, Tim, I think, quite an unusual one. Our question is from Erming, not the fur, and they're asking about an employee who is asking for lower payment. They have an hourly paid employee who has asked, could I have a third of my money this year, 2/3 next year, which will then obviously move that money into the new tax year and keep me in the basic rate band for this year. And then Erming says, any tax experts out there who can help with this? I think that's you, Tim.
Yeah, well, an interesting question that Erming has raised, and it touches on two things really. One is the effective tax point, to use a VAT term, for the tax liability for the recipient, the employee. I suppose three actually, because the second one I was going to mention was the tax deductibility for the company, and the third was the PAYE tax point. And you can understand why this sort of planning, which is what I would call it, springs to mind. There are various reasons why the employee in question might want to delay income in order to avoid higher rates of tax and have that income taxed at lower rates. Maybe they know that in the forthcoming year they're going to reduce their hours and so on, whereas in the year just ending they have had income that's taken that right up to the edge of the higher rate threshold. By the way, in the course of the responses to the original post, it's revealed that the employee in question is a family member, and it's a family company. The managing director has suggested this goes through for that employee, maybe the son or daughter of the managing director, I don't know. But let's address Erming's question. Erming's clearly uncomfortable with putting the income that's been earned through a month later than it ought to go through. So what is the tax treatment? Well, income is taxable on the employee on an earnings basis. For PAYE, the income is deemed to be income of the tax year in which the employee is entitled to payment of the earnings, and clearly that employee is entitled to payment in the current tax year. So that, I think, would make it, under the normal employment contract that this employee presumably is under, a no-go, a non-starter in terms of deferring the income into the new tax year. There's then some discussion about, well, what if it in fact is an overtime payment? So they're paid their regular weekly or monthly amount at the end of the month, but the overtime is carried forward to the following month. Maybe that could work, but again, you need to look at the contract. And if push comes to shove, and one has to say, it may well be that push never comes to shove. In a case like this, you just put through what you put through. But if push comes to shove and the revenue were to do a PAYE visit, they may very well query why that was delayed into the new tax year. And if they do dig deeper, discover that in fact, as Erming thinks, and I agree with Erming, it should have been put through the payroll, or at least should be taxed as income of the tax year in which those earnings were in fact earned. But it all touches on what is a bit of a vexed question, which is the deductibility for the company. Here it is a company, and the earnings have to be paid within 9 months of the year end. Well, they will be, so that's not a problem for the company. But also the problem for Erming is that PAYE obligation.
And of course, we're quite familiar with seeing this in terms of things like overtime, where we want to put overtime into a different year. You mentioned that one. And of course, bonuses is the other. But this year, bonuses, we've been talking about pulling towards us rather than pushing away from us to save that 1.25% health and social, national insurance to become health and social care levy, as opposed to moving it away, which was the question for Erming. So very unusual. Don't think we can do very much about that. Our second question comes from Jigs. And the question is about the lower earnings limit for directors. The question is, they've been reviewing a client payroll and two directors have been paying themselves just below the low earnings limit for several years. They're saying, my understanding is this means they're outside of the NIC contribution rules for state pension scenario, all that sort of thing. Is there anything we can do apart from simply pay class 3? And Tim, obviously very topical, shall we say, as a result of the announcements of Rishi Sunak just a few days ago.
Well, the increase in the primary threshold, but with no analogous change to the lower earnings limit, does bring this more to mind, let's say. And a brief reminder for AccountingWEB viewers that the lower earnings limit is the figure below which you're effectively off the radar for national insurance purposes. So if you have a low paid employee, or in this case, directors drawing very low monthly incomes, or it could be annual, and I forget the actual figure of the lower earnings limit, but it's between 6,000 and 7,000. So call it 6,500, something like that. If you've got employees paid below that figure, then there is no contribution payable, and they're not entitled to that very important year's credit, as it were, towards their single tier state pension. And you need to clock up 35 years. One of the posters, I think, to this question suggested 39, but normally it's 35 years of contributions in one form or another to qualify for the full single tier state pension. So they've missed it for several years. Now that means they're going to have a gap in their contributions record. One of the posters suggests that that gap might not be a problem because, of course, if you have a working life of, well, my working life so far depends whether you count when I started working with the local milkman on a milk round, probably not. So let me start my working life at, let's say, 21. Well, that's over 40 years ago. And so I have had plenty of opportunity to clock up the requisite number, in which case, let's not worry about it. But in other cases, they may well have a gap that needs plugging. And yes, the suggestion of voluntary class 3 is one way around it, but of course that's expensive. And no, I'm afraid, Jigs, there isn't any other way around it, unless, as I say, they have made it up or have time to make it up before they reach state pension age. But it does highlight the importance of setting the right salary or wages level. If you're looking at low paid employees, then you'll be doing them a favour by making sure that they are paid at least the lower earnings limit in order to get that credit towards their single tier state pension. And then for director shareholders, well, for 22-23, the new tax year, given the increase in the primary threshold to that not very easy to remember figure of £11,908, that's 3 months at the old and 9 months at the 12,570 new primary threshold, directors can take anything between the lower earnings limit of I think it's about 6,400 and that nearly 12,000 without actually triggering a liability to class 1, or indeed there will at higher levels be a liability to secondary contributions, but they will then be getting their entitlement to the single tier state pension.
Yeah, a very important thing to consider, and it's an important thing to consider every year. I think that's the point I would make. We often, with directors' salaries, we put somebody on a particular figure and then we don't review it, and that is the mistake, I suspect, here. You pay £6,000 when that was well above the lower earnings limit. Gradually that limit creeps up, and before you know it, we're in a position where we are underpaying, and therefore, as Tim's already said, very little we can really do. Hopefully useful to both questioners and also everybody else. We look forward to seeing you in a month's time. Keep posting questions and we'll see you then.